Hello everyone. Welcome to this week's Advisor Market Update. This week revealed powerful signals about where institutional capital is flowing and which risks are beginning to surface. From renewed analyst conviction in AI leaders to Warren Buffett's disciplined return to deal-making, this market is showing both sustained momentum in transformative technologies and early warning signs in economic fundamentals. Here's what advisors need to understand as we navigate this increasingly bifurcated landscape. Let's dive into what matters, starting with individual companies and what their moves are signaling. NVIDIA just got a significant vote of confidence. Goldman Sachs raised its price target to $210 a share, citing expanding partnerships with OpenAI and sustained strength across both hyperscaler customers and non-traditional enterprise buyers. 59 of 66 analysts now have a buy or strong buy rating. What makes this particularly notable is the breadth of demand Goldman is highlighting. Beyond the expected cloud giants, enterprise adoption is accelerating as companies move from experimentation to production-scale AI deployment. This demand diversification suggests the AI infrastructure build-out has room to run, even as valuations stretch. NVIDIA remains a core holding for AI exposure, but the analyst consensus also signals the importance of monitoring competitive dynamics as alternatives emerge. Moving to value investing, Warren Buffett is back in the deal game. Berkshire Hathaway just announced a $9.7 billion acquisition of Occidental's chemical unit, OxyChem. This is Berkshire's largest deal in years. By acquiring OxyChem, Berkshire gains exposure to cyclical upside in specialty chemicals while strategically avoiding the environmental liabilities that would come with Occidental's oil and gas operations. The structure is classic Buffett, combining preferred shares and dividends to generate consistent cash flow while positioning for long-term appreciation. At 95, Buffett's willingness to deploy nearly $10 billion signals his confidence in finding quality assets at reasonable valuations, even in a market many consider overheated. For advisors, this transaction offers a masterclass in patient capital allocation. And Tesla delivered a mixed message. The company reported Q3 vehicle deliveries up 7% year over year, exceeding expectations. But the stock fell over 5% as markets digested warnings about potential margin compression and concerns that demand strength may soften once tax credit benefits diminish. Goldman Sachs maintains a constructive view, pointing to upside potential from energy storage deployments and catalysts surrounding the November 6 shareholder meeting. This mixed reaction captures a broader tension in growth investing today. Strong operational execution meets skepticism about whether current valuations adequately reflect evolving risks. Now let's examine the broader economic landscape. The services sector just flashed a warning signal. The ISM Services Index declined to 50, matching the lowest reading since early 2020. Business activity and new orders both weakened materially, suggesting demand is softening across sectors. This follows 7 consecutive months of manufacturing contraction. The services sector has been the engine of U.S. economic resilience for the past 2 years, so this deterioration matters significantly. When services and manufacturing contract simultaneously, recession risk rises materially. For advisors, this data supports a more defensive stance, particularly in sectors that are sensitive to discretionary spending and business investment. Quality companies with pricing power and strong balance sheets become increasingly important in this environment. There's also emerging stress in private credit markets. UBS funds are facing over $500 million in exposure to the First Brands bankruptcy, with significant positions in supply chain finance and private credit structures. This offers a window into stress points that remain largely hidden from public markets. Private credit has grown explosively over the past decade, but credit quality and risk management practices vary widely. The First Brands situation may be isolated, or it could be an early indicator of broader dislocations as economic growth slows and borrowers face refinancing challenges. For advisors managing high net worth clients with private credit allocations, this underscores the importance of manager selection and portfolio diversification. Semiconductors are also showing technical warning signs. The VanEck Semiconductor ETF has surged 39% year to date, but technical indicators, including RSI readings above 80, suggest the rally may be overextended in the near term. Historical analysis shows similar setups have often led to negative returns over the subsequent 6 to 12 months. This doesn't diminish the long-term structural case for semiconductors, but it does suggest that investors who have underweighted the sector may want to wait for better entry points rather than chasing performance. With these dynamics in play, let's look at where opportunity is emerging. AI infrastructure investment is accelerating globally. A surge in AI-related deal activity helped drive major U.S. equity indices to record highs. This activity included BlackRock's global infrastructure partners nearing a $40 billion acquisition of aligned data centers. Simultaneously, Japan's Hitachi and Fujitsu announced deepened AI infrastructure partnerships, signaling that this investment cycle is truly global in scope. Despite concerns about stretched valuations, the pace and scale of deal flow reveal powerful institutional conviction. When sophisticated buyers like BlackRock deploy tens of billions into physical infrastructure supporting AI workloads, it validates the thesis that we're in the early stages of a multi-year build-out cycle. For investors, this creates opportunities beyond the obvious semiconductor plays. Data center REITs, power infrastructure companies, and specialized cooling and networking firms all benefit from this infrastructure arms race. The geographic diversification, particularly Japan's strategic push into AI partnerships, also suggests opportunities in international markets that have lagged U.S. technology leadership. So what are this week's signals telling us? We're seeing sustained institutional conviction in AI infrastructure, which is validated by record deal flow and elevated analyst targets. At the same time, Warren Buffett's return to large-scale deal-making shows that value opportunities exist even at market highs for patient, disciplined investors. But the economic backdrop is shifting. The service sector weakness and emerging stress on private credit suggests we're entering a more challenging environment, which will reward defensive positioning and quality over momentum. The bifurcation between technology leadership and broader economic fundamentals is widening, creating both opportunities and risks that require careful navigation. Thanks for watching, and we'll see you in the next update.